We're back. This is the part of the show called Ask Annex, where you head to the website, annexwealth.com, and click that Ask button. Fred Coleman, CFP and Wealth Manager, is here. Hey, Fred.
Hey, Danny.
Matt Morzy is Director of Research and a CFP. Hello.
Hey, Danny.
Question number one on Ask Annex. It's a big one. 53 years old and would like ideally to semi-retire or move to a lower stress job at 59. Currently, $750,000 in a 401k, contributing to the max annually, including catch-up. Have $370,000 in investment accounts, $100,000 in miscellaneous stock savings. Just opened a Roth IRA last year, $3,500. With 401k withdrawals being taxed, I was wondering if it makes sense to reduce my 401k contributions slightly in order to max out my Roth that is funded with after-tax money and no tax upon withdrawal. I figure by 62, I have $75,000 in my Roth, not accounting for any growth. You followed that, right?
I followed it for the most part, and this is great because you're starting to think about how you're going to distribute your assets, when you're going to distribute your assets, and the different tax buckets. One of the great things that I think this client did was getting that Roth bucket started, because remember, it has to be open for 5 years. You have to be 59 and a half in order to be able to withdraw all the funds tax-free. What I would do is, after looking at the company match, then looking to see if that Roth IRA makes sense. But you also have to look ahead to tax projections. So looking at what taxes are today, what you retiring earlier, there is an opportunity for them to be lower in the future. The other thing to think about, and I think this is what this question is getting at, is tax diversification. You want to have those different buckets. You have the pre-tax bucket taken care of. Seems like you have the taxable bucket. You have a nice amount in that. So ideally, those would be the funds that you would be able to use as that bridge. But also getting that tax-free bucket started is very beneficial. And the reason for that is because we don't know what tax laws will be. We're just projecting. We're looking at today. There's already been things floated out there that maybe capital gains will go up. Maybe income tax will be lower. Maybe income tax will be higher. We don't know. So by having that diversification and filling up those three buckets, then we have the ability to have a little more flexibility once you do retire.
I think you're hitting it on the head with that tax diversification. That's extremely important. You know, if you want the flexibility, especially retiring earlier, like you mentioned, and the question does as well too, you want to be able to pick and choose where you want to pull those proceeds out, you know, or the funds out in order to maximize your after-tax cost, you know, when you're looking at that. So I think that's really important. You know, knowing what your tax bracket is right now, which isn't a part of the question, would be really big in terms of giving something specific. But I think, you know, sitting down with you, Fred, and going through and putting all those numbers in and trying to plan out different scenarios of retiring at different times, different levels of part-time income, working through when to take money out of each is really important. And our financial planning team does a really good job when it comes to, you need $50,000 this year. This is what your tax bracket is. This is the account you should take this out of, or you should take a little bit out of each. They do a really good job with planning that out for our clients.
You are listening to Ask Annex from Annex Wealth Management. Second question. The 10 largest U.S. companies accounted for 14% of the S&P 500 stock index a decade ago. Today, they account for more than a third. That seems like a problem.
I don't think it's necessarily a problem. It's just the situation that we're in today. You know, right now, concentration in the U.S. markets is high. You know, it's higher than it has been, and the question does a really good job of pointing that out. But in the past, it's been just as high. We have to go back a little bit in time, but there's been other times where we've had large multinational companies, you know, that were leading the market from a market cap perspective. It's not necessarily a bug or a feature. It's just kind of where we are today. And when we look overseas, because we try to compare these things across the world, we're actually less concentrated than some of the foreign markets are as well, too. There's a lot of individual countries where they only have a couple really big companies, and then the rest of their market's really small. So it's not necessarily something that's unique to the United States. We've also done research that when you have this high level of concentration in companies, that's actually a really big positive for the market in terms of performance. So it's not something that we're worried about today, but it is certainly something to be aware of when you are investing and still trying to be diversified at the same time. And frankly, when we look at this concentration and looking at performance so far year to date, that concentration has really driven the market, and it has done so for the last couple of years. S&P is up about almost 17% so far as the time that we're recording this. If you equally weighted every single company in the S&P 500, it's only up almost 4%. So those large companies have really driven that performance. The things I think we want to watch out for is if we start to see some of them slip and maybe they're not hitting their earnings expectations and we start to see some pullbacks, one or two of them, okay. But if it starts to be more, there starts to be more of a trend that might have a down effect on the market if the rest of the market is not there to hold it up. Something to look out there for. But when we look at it, some of these companies that are leading the market, they have some distinct advantages in why they are that big. Some of them are somewhat monopolistic, which, could be a problem at some point, but their earnings are great. Their earnings growth is fantastic. It's better than the rest of the market, which is really good. They've got tons of cash on their balance sheet, so higher interest rates have not been affecting them at all. And they're companies that everybody goes to for just about every facet of our lives. And we're somewhat tied to having to go to some of them. So those are really big positives for them. Not necessarily you should go out and just go out and buy. It's not a recommendation when we say that, but it's something that when we're looking at the market, it's not something we're really afraid of right now.
Matt Morzy is Director of Research, also CFP at Annex Wealth Management. Thank you.
Thank you.
Fred Coleman, CFP and a Wealth Manager. Thanks.
Thanks, Andy.